On July 6, 2012, the Biggert Waters Flood Insurance Reform Act of 2012 was passed by Congress, making significant reforms to the National Flood Insurance Program, or NFIP.
Among other things, this law requires FEMA to take immediate steps to eliminate a variety of flood insurance subsidies. Here's a quick summary of the changes in flood insurance rates that are planned for 2013. First, subsidized rates are beginning to be phased out. What is the subsidized rate? A subsidized premium rate is one that does not reflect the true risk of flood to that property. Homes located in a high-risk flood zone, for example, zones beginning with an A or V for velocity zone, that were built before the first flood insurance rate map became effective for a community and that have not been substantially damaged or improved, may currently be receiving subsidized rates. These subsidized rates for pre-firm properties will be phased out. Secondly, some properties that previously could be issued at lower rates will move to full risk rates. Not everyone will be affected immediately by this new law. About 20% of all NFIP policies pay subsidized rates. Let's look at these changes in more detail. Currently, those non-primary, pre-firm properties in high-risk zones like A or V will see a phased-out removal of the subsidized rates beginning at renewal. A pre-firm property, again, is one that was built before the community's first flood insurance rate map or FIRM became effective and has not been substantially damaged or improved. The NFIP defines a non-primary residence as a building that would be lived in for less than 80% of the year. It would be possible for a homeowner to have two non-primary residences by this definition if they spent less than 80% of the year in each. Rates for these properties will increase 25% each year until they reach the full risk rates, or the property owner provides an elevation certificate that shows their actual risk.
Beginning in October 2013, subsidized rates on pre-firm business properties and severe repetitive loss properties will also increase at 25% per year until they reach full risk rates. Each property's risk is different. This includes any property that has incurred flood-related damages where claim payments exceed the fair market value of the property. For application purposes, a business property is any non-residential building that produces income, or a building designed for use as office or retail space, or for wholesale, hospitality, or similar uses. New applications will identify business properties separate from other non-residential buildings. Business properties will be rated as non-residential until the rulemaking process is complete.
Starting in October 2013, FEMA will begin to apply full risk rates after a property is sold, after the owner has allowed a policy to lapse, and when a new policy is issued for a building not covered as of July 6, 2012, the date of the BW12 enactment. It's important to note that after October 2013, subsidized rates can no longer be assigned to the new owner at the act of sale. The new owner will immediately begin paying full risk rates for insurance. Letting a flood policy lapse could prove costly. Also, new policies for buildings uninsured as of July 6, 2012 will reflect full risk rates. An elevation certificate, including photos, must be obtained within 1 year to determine the full risk rating. Provisional rates can be used for up to 1 year. Properties will be rated using post-firm procedures, and buildings with enclosures below the BFE will be rated as non-elevated buildings. Currently, the NFIP grandfathering procedure provides eligible property owners to pay insurance premiums based on the previous effective flood insurance rate map or FIRM. As planned in 2014, the NFIP reform will phase out grandfathered rates. Once a community receives new effective maps, full risk rates will be phased in over 5 years at a rate of 20% per year until they reach full risk rates. In this case, property owners may want to get an elevation certificate to establish actuarial rates for the structure. Remember that insurance is rated on effective maps. Communities can adopt new updated flood insurance rate maps at any time for compliance purposes, but properties will not be rated on these maps until they become effective. The Preferred Risk Policy, or PRP, will continue to be available. At this time, the future status of the PRP eligibility extension has not been determined. This PRP eligibility extension allows buildings newly mapped into a special flood hazard area to retain their PRP premiums for an additional period of time. Note that many of the changes in the NFIP have not yet been implemented. Existing subsidies and premium discounts remain available until the specific provisions of BW12 are implemented and triggered, and that will take time. Non-primary pre-firm residences were the first group to begin phasing out effective January 1, 2013. Subsidized rates for business properties and severe repetitive loss properties will begin phasing out in October 2013. Until specifically addressed as BW12 is implemented, new and renewing policies are still eligible for pre-firm subsidies, grandfathered premium discounts, and the Preferred Risk Policy eligibility extension. FEMA will clearly communicate when subsidies and discounted premiums are no longer available as analysis is completed and the implementation process moves forward.
Flood insurance premiums are based on flood risk. Therefore, as flood risk increases, flood insurance premiums also increase. Building above the base flood elevation reduces your flood risk. Properties that are lower than the BFE have an increased risk. Home and business owners whose properties have been flooded must make important decisions about repairing, rebuilding, or relocating their building. Consider building or rebuilding to higher elevations when there's an opportunity to mitigate for future flood risk. Community-wide discounts through FEMA's CRS program are not affected by BW12. If your community participates in the CRS program, savings may apply. Grant programs may also be available to support rebuilding or relocating, depending upon the state's priorities for use of grant funding. Higher deductibles can also lower premium costs. However, policyholders will be financially responsible for that expense at the time of the loss. Insurance agents are encouraged to maintain documentation in their files of the policyholder's request. Risk changes over time as conditions in the community change. Residents, business owners, and community leaders should take a look at their current flood risks and consider how those risks might change in the future. Building higher than your community's minimum requirements could result in lower flood insurance premiums and reduced flood risk. To learn how to build safer and stronger and potentially decrease your flood insurance premiums, visit www.fema.gov/building-science.
So to review, here's the timeline for upcoming changes in the NFIP. The flood insurance reform passed by Congress on July 6, 2012, reauthorized the NFIP and required FEMA to eliminate certain discounts and subsidies. January 2013 began the phase-out of subsidies for pre-firm, non-primary residences with pre-firm policies. The last section, which is anticipated in late 2014, is when we expect to see the phase-out of grandfathering. Homeowners are encouraged to see their insurance agent to learn how these changes will affect their personal property. Agents can stay informed on changes to the NFIP through Write Your Own alerts and additional agent workshops and webinars. Be sure to sign up for these through the links on this slide. Additionally, FEMA provides resources for your use and outreach efforts. Help your clients plan for changes in the NFIP that may affect them, and make sure you have the latest flood insurance rate manual on your desktop. Those links are also provided here.
The mission of FEMA is to support communities in becoming more disaster resilient by knowing their risk, planning for that risk, and mitigating and communicating about these risks. Everyone can take action to reduce their risk.
FEMA encourages local officials, citizens, and stakeholders to understand their risk and make informed choices for their community, families, and property. Flood insurance is one